Hey there, and welcome to the Deep Dive. We're here to sift through the stacks of information you've given us and pull out those fascinating insights, surprising facts, and crucial knowledge that truly makes you well-informed. Today, we're diving into a concept that touches every single one of us, often in ways we don't expect: gross income. Now, when you hear gross income, you probably think of that number on your paycheck before taxes, right?
hmm
Simple. But as our sources, including a very comprehensive guide on individual income taxes, reveal, the world of tax law sees income in a far broader, more nuanced, and frankly, sometimes mind-bending way.
It absolutely does. Our mission today is to uncover the fundamental ideas behind gross income, explore when it's officially recognized, who is responsible for paying tax on it, and reveal some very specific rules that can genuinely surprise you. We're going to try and connect the big picture of economic theory with the practical details of tax law, giving you those aha moments about why things are the way they are. We're talking everything from actual cash in your hand to, building your own log cabin, and even the latest buzz around virtual currency.
All right, let's unpack this. Our journey begins with the very foundation of tax law, the Internal Revenue Code. It defines gross income as simply all income from whatever source derived.
Yep.
That sounds incredibly broad, almost all-encompassing, doesn't it?
It really is, and that broadness is intentional. It harks back to the 16th Amendment of the Constitution. The critical implication here is this. Generally, all income you receive is taxable, unless the tax code explicitly states otherwise. It's an opt-out system, really.
An opt-out system, okay.
Yeah, and it's then up to the courts and the IRS to continually refine what income actually means in different situations.
So if it's all income, does that automatically mean all the money I receive? Like if I sell something for $100 that only cost me $50, is the whole $100 considered income?
That's a great question, and it brings us to a crucial distinction. The Supreme Court clarified that gross income isn't the same as gross receipts. This introduces a fundamental principle called the recovery of capital doctrine. It basically means you don't actually have taxable income until you've recovered your initial investment, your capital, in whatever you've sold.
Okay, recovery of capital.
Think of it this way. Imagine you buy a damaged car for $400. Later, you sell just the radio from that car for $75. That $75 isn't necessarily income yet. You're just recovering a piece of your original $400 investment.
Ah, I see.
Only after you've recouped your entire $400 cost from selling various parts would any further sales proceeds become taxable income. It's a simple idea, but absolutely vital. You get your initial investment back first, tax-free.
Right. That makes a lot of intuitive sense. But our sources then delve into two big, sometimes competing ideas from the early days of tax law: economic income versus accounting income. What's the core difference, and why does it really matter to us as taxpayers?
Well, this raises an important question about how we define true wealth creation. Economic income is a much broader concept. An economist would look at your income as the value of everything you consumed, plus any increase in the value of your assets, whether you sold them or not.
Consumed plus increase in value.
Okay, yeah, it's about how your total wealth changes, even if no money changes hands.
So if I buy a rare vintage comic book for $100, and by the end of the year it's suddenly worth $1,000, an economist would say I've made $900 of income, even if I still own the book.
Precisely. You have an economic gain, no doubt. But the courts largely rejected this approach for tax purposes.
Why was that?
Three main reasons, really. First, valuing things you haven't sold, especially unique items, can be incredibly subjective. How do you really know what it's worth without a sale? Second, imagine the burden of valuing everything you own annually. It would be immense, impractical. And third, what we call the wherewithal to pay issue. This simply means, how do you pay tax on an asset that's appreciated on paper, but you haven't converted to cash? You might not have the money readily available, right?
Right. Makes sense. You can't pay taxes with a comic book.
Exactly. So instead, tax law largely adopted the accounting concept of income, which is built on the realization principle. This principle requires two key things. First, an exchange of goods or services with an independent party, and second, receiving something in that exchange that can be objectively valued.
Okay, an exchange and objective value. Here's where it gets truly interesting with an example from our sources. Imagine Ted, a teacher, decides to build a log cabin for his own personal use.
Right.
He spends $40,000 on materials. When he finishes, the fair market value of that completed cabin is $60,000. He's certainly $20,000 wealthier in a real sense, right?
He absolutely has an economic gain, $20,000 richer. But under the realization principle, Ted has no gross income from building that cabin.
No income, even though it's worth more.
Correct. Why? Because no exchange took place. He built it for himself, and he still owns it. There's no transaction with another party. Now, if he later sells that cabin to Sally for $65,000, then he realizes a $25,000 gain, 65K sale price minus $40K cost basis,
Yeah.
because his property rights have substantially changed, and he's received cash in an arm's length transaction. That's a huge aha moment. Personal effort, even when it creates significant value, isn't taxed until it's realized through a verifiable transaction.
So it's not just about getting cash. Receiving property or even services can count as realized income if they have a clear objective value.
Exactly right. Think of getting paid in stock or maybe receiving free room and board as part of your compensation package. These are generally taxable income if you can put a clear dollar value on them.
Okay, we've nailed down what gross income generally is. But the next crucial piece of the puzzle, and one that often surprises people, is when that income actually counts for tax purposes. The U.S. tax system operates on an annual accounting period, usually the calendar year for most of us. But how do we decide when specific income falls into that year?
That largely depends on your accounting method. Most individuals and many smaller businesses use the cash receipts and disbursements method, or simply the cash method. Under this method, income is recognized when you actually or constructively receive it, regardless of when you technically earned it, when the cash or equivalent is in hand or available.
So if a client pays me for work I'm scheduled to do next January, but they send the check in December, that income counts in December for my taxes if I use the cash method.
That's right. If you get the check in December, it's December income. And receipt isn't just physical cash. As I said, a check is considered a cash equivalent. However, if someone just owes you money, like a verbal promise or maybe a simple bill you sent out, that's not usually income until it's actually collected by a cash basis taxpayer.
Okay. And the other method?
The accrual method, which most larger businesses use, is different. Income is included when two things occur. You have a fixed right to receive the income, and the amount can be determined with reasonable accuracy. Even if the payment isn't in your bank account yet, it counts.
Got it. And there's a fascinating rule for us cash basis folks called constructive receipt. It sounds a bit like the IRS is peering over your shoulder.
Heh. Well, it's crucial for tax planning because it prevents people from playing games with timing. Income is constructively received if it's made readily available to you and not subject to any major limitations or restrictions.
Readily available.
Yeah, the idea is to stop you from deliberately deferring income you could easily have. For example, if your employer offers you your December bonus check in December, but you tell them, just hold it until January, for tax purposes, you've still constructively received it in December. It was available to you. You chose not to take it.
That makes perfect sense. You can't just choose to delay. What about interest on investments like bonds? Are there any timing quirks there?
There can be, yes. For original issue discount OID bonds, like zero coupon bonds where you buy them cheap and they mature at face value later,
Right, I know those.
cash basis taxpayers actually have to report a portion of the interest income annually, even though they haven't received any cash yet.
Really? Even without cash?
Yeah. The key insight here is that tax law isn't always intuitive. Sometimes it forces you to recognize income you haven't actually received yet. It's accruing value. However, U.S. savings bonds, like Series E and E bonds, are a notable exception. You can generally defer reporting that interest income until you cash them in or they mature, or you can choose to recognize it annually.
So more flexibility there.
Exactly. This provides incredible flexibility to defer income, which can be a powerful planning tool for things like college savings.
That discussion of when income counts brings us naturally to some very specific scenarios where the rules might surprise you. Let's start with divorce and support payments, alimony, and separate maintenance. This is an area where the rules have really changed recently, haven't they?
They really have. It's a prime example of how tax law changes can have a huge impact on real people's lives. For divorce agreements finalized after 2018,
After 2018, okay.
alimony payments are neither taxable to the recipient nor deductible by the payer. It's just neutral.
Wow, okay. So it doesn't affect income tax for either person.
Correct. However, for agreements made on or before December 31st, 2018, the old rules apply. The payments are taxable income to the recipient and deductible by the payer.
So the timing of your divorce agreement makes a world of difference for the tax consequences for both parties. Huge difference.
Absolutely massive. And what about property settlements, like one spouse transferring their share of a house to the other?
Yeah.
Those are generally tax-free transfers with no immediate gain or loss recognized at the time of transfer. The basis just carries over.
Okay. And child support.
Child support payments are entirely separate. They're never deductible by the payer nor taxable to the recipient, regardless of the agreement date. That's always been the case.
Clear distinction.
This brings up William and Abigail from our discussion questions. If Abigail supports William through medical school and he then makes payments to her after the divorce, under current rules, assuming their agreement is post-2018, that reimbursement wouldn't have tax consequences for either party. It's not deductible for him, not taxable for her.
Interesting how that plays out. Speaking of surprising scenarios, how do below-market interest loans work for tax purposes? It sounds like the IRS is telling me I can't just lend money to a family member interest-free without consequences.
That's essentially it, yeah. This rule is designed to prevent people from subtly shifting income or wealth without paying tax. If you make a loan at 0 or a very low interest rate, the IRS can impute interest.
Impute interest?
Yeah, they'll pretend interest was charged at a reasonable rate based on federal rates, and then that phantom interest is treated as income to the lender and potentially as a gift from the lender to the borrower, or maybe compensation if it's an employer-employee loan.
So it creates taxable income, even if no interest was actually paid.
Exactly. It can create taxable income for the lender and possibly a gift tax issue. There are exceptions, of course, like small gift loans under $10,000 between individuals. But the general principle is to ensure that the economic reality of the use of money has value is reflected for tax purposes.
Okay. What about annuities, those income streams many people rely on in retirement? How are they treated?
Annuities involve a stream of future payments, and for tax purposes, you get to recover your original investment or cost over the annuity's estimated life, usually based on actuarial tables. A portion of each payment is considered a tax-free return of your own capital. That's the exclusion amount. The rest is taxable income.
So part tax-free, part taxable.
Initially, yes. Once you've recovered your full cost, though, all subsequent payments become fully taxable.
Got it. Prizes and awards like winning the lottery or even a local contest are generally taxable, right? Pretty straightforward.
Correct, generally. The fair market value is usually included in your gross income. However, there are some very specific, narrow exceptions. For instance, if you receive an award for a religious, charitable, scientific, or civic achievement, think like a Nobel Prize, you can exclude it if 3 conditions are met.
Okay, what are they?
1, you were selected without any action on your part to enter. 2, you're not required to render substantial future services. And 3, and this is key, you assign the prize directly to a qualified charity or government organization before you receive it.
So if you win a Nobel Prize and have the cash sent directly to a designated charity, you might completely avoid the tax hit yourself. That's a neat trick.
Precisely. You never actually possess it. And, a timely note, Olympic and Paralympic medals and associated cash awards can often be excluded for athletes with income below a certain threshold. It's sort of a recognition of their service.
Interesting. And unemployment compensation, is that taxable?
Yes, that one is pretty straightforward, fully includable in gross income.
Okay. Now, what about Social Security benefits? This one seems to get pretty complicated for a lot of people.
It truly does, and it's because the taxability is tied to your overall income level. The system tries to tax benefits for those who have more ability to pay. The key concept here is your modified adjusted gross income, MAGI. This is basically your regular adjusted gross income plus certain items normally excluded, like tax-exempt interest.
Oh, okay.
Then we look at your provisional income, which is your MGI plus 50% of your Social Security benefits. Depending on that provisional income number, a portion of your Social Security benefits, either 0% up to 50% or up to 85%, can become taxable.
So it depends on how much other income you have, essentially.
Exactly. For a single taxpayer, roughly, if your provisional income is below $25,000, generally none of your benefits are taxable. Between $25,000 and $34,000, up to 50% can be taxed. If it's over $34,000, up to 85% of your benefits can be taxed.
And there are similar thresholds for married couples.
Yes. Higher thresholds for married couples filing jointly, starting at $32,000 and $44,000 for the 50% and 85% inclusion levels, respectively.
This brings up Carlos from our discussion questions. He's retired on Social Security and wins $5,000 on a game show. His gross income could actually increase by more than just a $5,000 prize. How does that work?
It's that ripple effect. The $5,000 game show winnings push up his MGI. That higher MGI, when added to half his Social Security, increases his provisional income. This increase might push him over one of those thresholds, causing, say, 50% or even 85% of his Social Security benefits, which might have been entirely tax-free before, to suddenly become taxable. So the $5,000 prize could trigger tax on thousands of dollars of Social Security benefits.
Wow, that's a huge takeaway. Extra income isn't always just taxed on its own. It can make other income taxable, too.
Precisely. Finally, a very important reminder for many listeners today about foreign bank accounts.
Right, the FBAR.
Exactly. This isn't about the income in the accounts being taxed differently necessarily, but the reporting of the existence of these accounts. If you have an aggregate value across all foreign financial accounts exceeding $10,000 at any point during the year,
Just $10,000 total.
yes, $10,000 aggregate total at any point, you are required to file FinCEN Form 114, the Report of Foreign Bank and Financial Accounts, or FBAR, electronically. It's separate from your tax return. And the penalties for non-compliance are substantial. They can be up to 50% of the value of the accounts in some cases. So it's really critical to be aware of this filing requirement.
Okay, good warning. Let's shift gears now to gains and losses from selling property. How does that typically work?
Okay, so first, just like with Ted's Cabin, you need a transaction, a sale or exchange for a gain or loss to be realized. The formula is quite simple, conceptually. Your amount realized from the sale, that's the selling price minus any costs of selling, like realtor fees, minus your adjusted basis equals your realized gain or loss.
An adjusted basis is usually cost plus improvements minus depreciation, if applicable.
That's generally right. Cost plus capital additions minus depreciation taken. Now, generally, if you have a realized gain, it's taxable, we say it's recognized. But here's a crucial distinction for individuals. If you sell a personal use asset, like your car or your furniture or even your main home, though there are special rules there,
Yes.
if you have a gain, that gain is usually taxable. However, if you sell it at a loss, that loss is generally not recognized for tax purposes. You can't deduct losses from the sale of your personal stuff.
So if I sell my car for more than I paid, unlikely, but possible, that gain is taxable. But if I sell it for less, which is almost always the case, I can't deduct that loss. It really is a one-way street sometimes.
That's typically the case for personal use assets. Yes, business assets are different. But for personal items, gains are taxed, losses are usually ignored.
Okay.
Once you have a recognized gain or a loss, the next step is classifying it as capital or ordinary, because that affects your tax rate significantly.
Ah, capital gains and losses. This is where things can get really interesting, especially with those preferential tax rates everyone talks about.
Indeed. Capital assets are essentially most assets you own except for specific business-related items. Think inventory, accounts receivable generated by a business, or depreciable property actually used in a trade or business. So for most individuals, capital assets typically mean assets held for personal use, like your home, your car, jewelry, and investment purposes, like stocks, bonds, or undeveloped land.
And collectibles, like art or stamps.
Yes, collectibles such as art, antiques, gems, or certain coins are also capital assets, but sometimes have unique tax rules or rates applied to their gains.
So what exactly are these preferential rates for capital gains? How much better are they?
The big benefit comes with long-term capital gains. These are gains from selling capital assets you've held for more than 1 year.
More than a year. Got it.
These gains generally enjoy lower tax rates, often 0%, 15%, or 20%, depending on your overall taxable income level, much lower than ordinary income rates for many people. In contrast, short-term capital gains from assets held for 1 year or less are simply taxed as ordinary income at your regular tax bracket, which can be as high as 37%. So that holding period crossing that 1-year mark is absolutely critical for getting the lower rates.
Huge difference. And what if I have capital losses? Can those help offset my income?
They can, but there's a limit. For individual taxpayers, you first use capital losses to offset capital gains. If you still have a net capital loss after that,
Yeah.
that net capital loss can only offset up to $3,000 of your ordinary income per year, $1,500 if married filing separately.
Only $3,000 a year against ordinary income.
That's the limit per year. Any unused loss beyond that $3,000 can be carried over indefinitely to future years, where it can offset future capital gains or that same $3,000 of ordinary income. So while helpful, it's not an unlimited deduction against your regular income.
Okay, $3,000 limit, carry for the rest. Here's where it gets truly eye-opening for a lot of people today. Digital assets, including virtual currency. How are these treated for tax purposes? This is still new territory for many.
It really is. And the tax law is definitely playing catch up with the technology. A digital asset is broadly defined. It's any digital representation of value recorded on a cryptographically secured distributed ledger, like a blockchain, or similar tech. So this obviously includes virtual currencies like Bitcoin or Ethereum, but also NFTs and other tokenized assets.
Okay, broad definition. What's the key tax point?
The crucial point established by IRS guidance is that virtual currency is treated as property for tax purposes, not as a foreign currency.
Property, like a stock or a collectible.
Exactly, just like property, and that has major implications.
So if I use Bitcoin to buy a coffee or trade my Bitcoin for Ethereum, that's a taxable event, just like selling a stock. That seems like a lot to keep track of for potentially small, everyday transactions.
Absolutely. That's the consequence. When you use virtual currency to acquire goods, services, or even exchange it for a different virtual currency, it's treated as a disposition of property, a sale. Any gain or loss on that sale, the difference between the value when you used it and what you originally paid for it, your basis, is taxable to the holder.
Wow.
This means tracking your cost basis, what you paid for that specific unit of Bitcoin or whatever currency, and the fair market value at the exact time of the transaction is vital. It can get complicated fast.
No kidding. And our sources mention specific reporting requirements are coming soon, making this even more critical for taxpayers.
Yes, this is a very significant development. Starting in 2025 for transactions in 2024, digital asset brokers think exchanges like Coinbase or Kraken will generally be required to report customer sales and exchanges to the IRS on a new Form 1099-DA.
Like a 1099-B for stocks.
Essentially, yes. It will provide cost basis information in many cases, which should help, but the responsibility ultimately lies with the taxpayer. And even now, the 2024 Form 1040 includes a direct question right near the top asking if you received, sold, exchanged, or otherwise disposed of any digital assets. It's a clear signal. The IRS expects you to report these transactions.
Okay, the days of flying under the radar are definitely over there.
Pretty much.
Wow, what a deep dive into the surprisingly complex world of gross income. From, Ted's untaxed log cabin build to Alice's architectural fees being taxed to her even if paid to her daughter. And that critical distinction between pre- and post-2019 alimony rules, we've seen that income is far, far more than meets the eye.
And remember how other income, like Carlos's game show winnings, can have that unexpected ripple effect, suddenly increasing the taxable portion of his Social Security benefits. That's a shocker for many. Or how digital assets are now firmly treated as property, making every single virtual currency transaction, even buying a coffee, a potential taxable event. These details really underscore how vital it is to understand the mechanics of income recognition for your own financial well-being.
Yeah, this whole discussion really highlights the delicate balance the tax system tries to strike. It's trying to be fair, it needs to be practical to administer, but it's also clearly trying to influence social and economic goals sometimes. It's not just about what you earn, but how the law defines it, when it gets counted on your return, and who ultimately is responsible for paying the tax on it.
Indeed. And as you, our listener, think about your own financial life and plans, what stands out to you as the most surprising or impactful concept we've discussed today? Perhaps the sheer breadth of that initial definition, all income from whatever source derived. Or maybe the power of the realization principle, no tax until a transaction. Or even the potential for strategic tax planning through understanding timing, like with those Series E bonds or attribution rules. It really makes you consider the choices we make, large and small, and their sometimes unexpected tax implications, doesn't it?
That's a fantastic thought to chew on. Until next time, keep digging, keep questioning, and keep getting well informed.